For 50 years, the entire architecture of American financial dominance rested on a single, unwritten understanding sealed in a series of quiet 1974 meetings between Washington and Riyadh. Saudi Arabia would price its oil exclusively in dollars and recycle its oil revenue back into American Treasury securities. And in exchange, the United States would guarantee Saudi security. That arrangement, known as the Petrodollar system, gave the dollar its status as the currency every nation on Earth needed to hold simply to buy energy. And it is the single most important reason the United States has been able to run sustained trade and budget deficits for half a century without the kind of currency crisis that would cripple any other country attempting the same thing. Here is the number that should be reordering every macro strategist's risk model right now. In June 2024, the formal 50-year petrodollar agreement quietly lapsed, and unlike virtually every other moment in modern financial history, nobody renewed it. Nobody announced its expiration, and almost no mainstream financial coverage marked the date at all. The petrodollar system didn't collapse in a dramatic currency crisis. It just expired. Like a lease, nobody bothered to resign. And the silence around that expiration is itself the most important signal in the entire story. The mechanics of why this matters require understanding what actually made the petrodollar system powerful in the first place, because it was never really about oil. It was about recycling. When oil-importing countries needed dollars to buy Saudi crude, they had to first earn or borrow dollars, which meant maintaining dollar reserves, conducting trade in dollars, and ultimately holding dollar-denominated assets, overwhelmingly U.S. Treasury securities, as the safest store of value for those reserves. Saudi Arabia itself, flush with oil revenue priced exclusively in dollars, recycled the bulk of that revenue directly into U.S. Treasuries and U.S. financial markets, effectively financing American government spending and keeping American borrowing costs artificially low for decades. This is the mechanism economists call the exorbitant privilege, the unique ability of the United States to borrow in its own currency at rates other countries could never access, made possible specifically because global oil trade, the largest commodity market on Earth, ran exclusively through dollars and recycled its profits back into American debt. The unwinding of this system did not begin in 2024. It began in earnest in March 2023, when Saudi Arabia's finance minister, speaking at the World Economic Forum in Davos, stated publicly and without ambiguity that Saudi Arabia was open to conducting trade in currencies other than the dollar for the first time in the kingdom's modern history, an extraordinary public reversal of a policy so foundational to global finance that most economists had stopped treating it as a policy choice at all and started treating it as a fact of nature. Within months, Saudi Arabia and China conducted their first direct yuan-denominated oil trade settlement, a transaction that would have been unthinkable a decade earlier, given Saudi Arabia's deep institutional and security ties to Washington. By 2025, China had become Saudi Arabia's largest single trading partner by total trade volume, exceeding the United States, and Saudi Arabia's own central bank had entered a currency swap agreement with the People's Bank of China worth approximately $7 billion, the kind of bilateral financial infrastructure that doesn't generate headlines but quietly builds the institutional plumbing that makes non-dollar settlement easier with every transaction that flows through it. The Gulf states' motivation for this shift is not ideological. It is a cold-eyed risk assessment that has been building for over a decade, and understanding its components reveals why the trend is structural rather than a temporary diplomatic gesture. The first driver is the demonstrated American willingness to weaponize dollar-based financial infrastructure against sovereign actors, most dramatically illustrated by the freezing of approximately $300 billion in Russian central bank reserves following the 2022 invasion of Ukraine. For Gulf sovereign wealth funds and central banks holding hundreds of billions of dollars in dollar-denominated reserves, the Russian sanctions were not an abstract geopolitical event. They were a direct demonstration that dollar reserves, no matter how large, are not truly sovereign assets, but are, in the final analysis, claims against an American financial system that the American government can freeze unilaterally if it judges a country's foreign policy sufficiently objectionable. Every Gulf finance minister watching that freeze unfold drew the same conclusion. Diversification away from total dollar dependence is no longer a theoretical hedge. It is basic risk management. The second driver is the erosion of the security guarantee that justified the original 1974 bargain in the first place. The implicit Saudi understanding was always that pricing oil in dollars and recycling revenue into American assets bought a durable American security commitment to the Saudi regime's survival, including against external threats and, implicitly, against the kind of domestic destabilization that toppled other regional monarchies. That guarantee has looked progressively less reliable to Gulf planners across several American administrations of different parties, through the 2019 Abqaiq oil facility attack that received a notably restrained American response, through the prolonged and ultimately incomplete American disengagement from the broader Middle East following the Afghanistan withdrawal, and through the genuine American policy fatigue with open-ended Gulf security commitments that has been a bipartisan undercurrent in Washington foreign policy debates for over a decade. If the security guarantee underpinning the petrodollar bargain is no longer as reliable as it once was, the logic of exclusively pricing oil in dollars and recycling revenue into American assets weakens correspondingly, which is precisely the calculation Gulf states appear to have made. The third driver is the sheer scale of Chinese demand and the diplomatic leverage that scale provides. China imports more crude oil than any other nation on Earth, sourcing an estimated 18% of its total oil imports from Saudi Arabia alone, and Beijing has made the yuan internationalization of Gulf energy trade an explicit, sustained diplomatic priority for over a decade, backed by the kind of patient, incremental relationship building, infrastructure investment, and currency swap diplomacy that has characterized Chinese economic strategy across the entire Belt and Road footprint. China brokered the stunning 2023 restoration of formal diplomatic relations between Saudi Arabia and Iran, a diplomatic achievement that would have been considered an American sphere of influence project for decades, demonstrating a level of Chinese diplomatic credibility in the Gulf that simply did not exist as recently as 2015. Every Gulf state now treats Beijing as a serious alternative pole of diplomatic and economic engagement, not a replacement for the American relationship. Most Gulf planners are explicit that they are hedging rather than switching allegiance entirely, but a genuine alternative that did not meaningfully exist a generation ago. The numbers behind the shift, while still representing a minority of total Gulf oil trade, are moving in a single consistent direction with no signs of reversal. The dollar's share of global foreign exchange reserves has declined from approximately 71% in 1999 to approximately 58% today, the lowest level in 3 decades, with the decline accelerating specifically since 2022. Yuan-denominated cross-border payment volume processed through China's CIPS settlement system, the Chinese alternative to the Western SWIFT network, has grown at a compound rate exceeding 30% annually since 2020, still a small fraction of total global dollar-denominated trade in absolute terms, but expanding from a base that was negligible only a decade ago, which is exactly the kind of exponential network effect growth curve that monetary economists watch most closely, since currency network effects tend to compound rather than grow linearly once a critical mass of participants is reached. The BRICS bloc expanded in 2024 to include Saudi Arabia, the UAE, Egypt, and Iran alongside the original Brazil, Russia, India, China, and South Africa membership, now represents a combined GDP exceeding the G7 on a purchasing power parity basis and has explicitly discussed, without yet implementing, mechanisms for expanded local currency and alternative currency trade settlement among members specifically, designed to reduce collective dollar dependence over time. None of this means the dollar is about to lose its global reserve currency status in any near-term, dramatic sense, and serious monetary economists are nearly unanimous that predictions of imminent dollar collapse are badly overstated. The dollar's advantages, the depth and liquidity of U.S. Treasury markets, the rule of law protections for foreign asset holders within the American legal system itself, the sheer size and openness of the American economy remain formidable and are not easily replicated by any alternative currency arrangement, including the yuan, which remains subject to Chinese capital controls that make it fundamentally unsuitable as a true reserve currency alternative for any country unwilling to accept Beijing's direct influence over its own capital flows. What is actually happening is something more gradual and, in some ways, more consequential than a dramatic collapse. A slow, structural diversification away from total dollar dependence in the one commodity market, oil, that gave the dollar its most foundational source of artificial demand, conducted not through confrontation, but through exactly the same patient, transaction by transaction, relationship by relationship accumulation of alternative infrastructure that has characterized every other instance of Chinese strategic competition examined throughout this analysis. The consequences for American policy and for ordinary Americans are not abstract, even if they unfold over years rather than overnight. Reduced foreign demand for dollar reserves and U.S. Treasury securities means, at the margin, higher borrowing costs for the American government and, by extension, for American mortgages, auto loans, and corporate borrowing that are priced off Treasury yields. The Congressional Budget Office's own long-term projections already show net interest payments on U.S. federal debt exceeding $1 trillion annually and projected to surpass the entire U.S. defense budget within the current decade, a trajectory that becomes meaningfully worse, not better, if foreign central banks and sovereign wealth funds continue gradually reducing the share of their reserves held in dollar assets. The exorbitant privilege that allowed America to borrow cheaply for 50 years was never a permanent law of economic nature. It was a negotiated arrangement, built on a specific set of mutual incentives between Washington and Riyadh that made sense in 1974, and that has been quietly, gradually, deliberately renegotiated by every Gulf finance ministry watching the same signals over the past decade. Project this forward, and 3 scenarios frame the plausible range of outcomes over the next decade. Scenario 1, gradual continued diversification without crisis. The dollar's reserve share continues its slow decline. Gulf states continue expanding multi-currency trade settlement at the margin while still conducting the large majority of oil trade in dollars, and the American financial system adapts to modestly higher borrowing costs without a disorderly crisis. This is assigned the highest probability by most monetary economists, typically in the 50 to 60% range, reflecting the genuinely gradual nature of reserve currency transitions historically, which tend to unfold over decades rather than years, even once the underlying trend is clearly established. Scenario 2. An accelerated shift triggered by a specific crisis event, a major new round of American sanctions affecting a significant economy, a sharp deterioration in U.S. fiscal credibility, or a geopolitical event that further damages confidence in the security guarantees underpinning the dollar system, that compresses what would otherwise be a multi-decade transition into a much shorter and more disruptive window. This carries a moderate probability, often estimated around 20 to 25%, and would have far more severe and immediate consequences for American borrowing costs and financial stability than the gradual scenario. Scenario 3, a managed American policy response. Washington, recognizing the structural risk, pursues credible fiscal consolidation, rebuilds Gulf Security Trust through renewed and more reliable commitments, and works to preserve dollar centrality through deliberate policy rather than inertia. This is assigned the lowest probability among the 3, often cited around 15 to 20%, reflecting the deep structural and political obstacles, particularly around fiscal discipline, that have made this kind of proactive American policy response difficult to sustain across multiple electoral cycles. Whichever scenario unfolds, the lesson embedded in the petrodollar's quiet 2024 expiration is the same lesson running through every other story in this analysis. The foundations of American financial and strategic dominance built in the mid-20th century are not being challenged through dramatic confrontation. They are being patiently, quietly renegotiated. One bilateral currency swap, one yuan-denominated oil cargo, one BRICS summit communique at a time, by a set of actors who have learned that the most effective way to dismantle an architecture nobody else is willing to formally contest is to simply stop showing up to renew it, and to let everyone else discover, gradually and much later than they should have, that the agreement they assumed was permanent had quietly expired with no ceremony at all.